I mean, you learn a lot along the way with construction and, like the things that really hit you, like sewer, foundation, roof, electrical, plumbing, that not a lot of people talk about, but it is probably the most costly thing that you don't really get paid for.
Listen, everybody, we all know that real estate is the most proven way to build wealth. But why isn't everyone wealthy from real estate then? It's hard to know where to start, and most of the education out there is just complete trash, and you end up investing your money on a series of courses instead of in real estate. That's not how this podcast works. We give you the blueprint to successful real estate investing and bring on guests actually willing to share their secrets. I started my real estate investing journey as a freshman in college when I bought my first duplex and have been in the trenches doing deals ever since. And today, I now own hundreds of millions of dollars of investment property. On this podcast, you will learn what you actually need to know to be a successful active or passive real estate investor. And we'll offer our takes on what's happening today so you can navigate this market and build wealth. I'm Drew Brenneman, and this is the Brenneman Blueprint.
All right, welcome to another episode of the Brenneman Blueprint. Have Jonathan Barr with JB2 Investments on the podcast today. Excited for today's episode. Jonathan's got a interesting angle on how he's doing multifamily investing, kind of similar to some of the stuff I've done. So it definitely resonated with me. So happy to have him on. So welcome, Jonathan.
Hey, thanks for having me on.
Yeah, so I think why don't we just get right into it? I mean, why don't you tell us maybe how you got to where you're at today investing in multifamily?
Yeah. So I started in '09 after the the GFC. And my family had been flipping homes since basically the 80s. And so I graduated college in '08, couldn't find a job. My mom said, come work with us. I reluctantly went to do that because who wants to work with their parents? And we started almost immediately going to the foreclosure auctions and buying homes that way. And we got to a point where we were buying 8 homes a month. We bought about 400 homes in LA that we flipped over a 10-year period, a lot of them coming from those auctions and REOs. And during that 10-year period, I bought a few duplexes in good parts of LA that I held over that 10-year period, which I've subsequently sold along with my brother, who's my partner in the current business. He sold some of his properties and we exchanged that into properties in the Midwest. The first one was in 2019 in Kansas City. 4x my cash flow I was making before, and then we kind of just started building from there, and then eventually started raising money from others as well.
Nice. And so then originally, I guess, so getting into the family business with flipping, that was you didn't want to do that. What were you thinking you wanted to do maybe back in 2008?
I mean, I think it wasn't terrible. It's a constant grind. You're going to projects all the time. We were doing mostly gut jobs, so tons of surprises, things coming up. It also just started kind of drying up with REOs drying up and just like less deals being there. And at the same time, I was looking at these duplexes that were kind of adding up and starting to pay for like my livelihood. And then I started to see what the value of it was. And I saw that if I sold these duplexes, I would actually make more money than the 10 years previously I'd made through the flips of my share of the profits. And I was like, okay, I got to keep doing this. Yeah.
On one duplex or on all 3? That eclipsed your share of the 400
all 3.
flips?
All 3.
Wow.
Yeah, not just one. Yeah.
Yeah.
I did pretty well doing that too, but it still was like an aha moment. I was involved with 400 flips, yet I made making more money off 3 properties.
Yeah, that's really telling. And I mean, because especially, somewhere like LA, I mean, a lot of the return's going to be from appreciation and holding on to the properties, where then, I mean, flips you're able to push a lot of value quickly, but then oftentimes you got like hard money loans and maybe partners or something that's, got their hand in it too.
Yeah. And another thing too is like I watched people resell our flip and make more money than we did just by holding it for 3-4 years.
Yeah. I know.
And I was like, we went through all this hell and these people just live in it for a few years and make more money than us.
Yeah. I know. So, someone, so then if you feel like what mistakes did you make during that time? If you will, like Because I guess what comes to mind, when people ask me that, I usually say like, oh, I sold it and I didn't roll the money forward to another deal. Like that's when I thought of that, where it's like, especially if that money didn't make its way into another deal, then that's tough
I
to
mean,
see
we were
someone.
always rolling that money into other deals.
Nice.
Mistakes. I think the only mistake that I really did that comes to mind is at the auctions, we bought a second and had a big loss on one of the properties. So that was one of the big mistakes.
A second mortgage position.
Yeah, a second when we thought we were buying it for first. So that we took a big hit but 1 out of 400, that's not terrible. I mean, just you learn a lot along the way with construction and, like the things that really hit you, like sewer, foundation, roof, electrical, plumbing, that not a lot of people talk about, but it is probably the most costly thing that you don't really get paid for.
Yeah. Like if your sewer's broken in the street, how much does that cost to open up the street and do in LA?
At least 10 grand. It could be more.
Yeah. Chicago,
15.
I've done it on a couple, like 6 to 8 units, and there's 15 grand on one and almost 20 on another.
Yeah, that's not unusual for LA either. Yeah.
Yeah. Right. And nobody thinks about that. They just assume it's working.
And a tenant or a buyer on the buyer ends are like, oh, I got a new sewer. I mean, it does definitely helps if they know that, but you're not getting that money back necessarily.
Yeah, I don't think on a sewer. At least I bought a house, one that I lived in, and the water line was brand new, which I thought was great, because then we had a new copper pipe. But your sewer, I don't really care on how new that, as long as it's working.
Yeah.
As the homeowner. But yeah, that's interesting, because then I guess too, like a lot of those flips, then you guys were paying just full ordinary income tax on, I'd imagine.
Yeah. So that's another part. Like I was taking some pretty big tax hits when now I basically don't pay taxes because of the longer term hold and depreciation and accelerated depreciation and all that. Like I didn't even know accelerated depreciation existed till I started getting into the multifamily world.
Nice. Yeah. Why don't you tell us about that?
You usually depreciate the property over 27 and a half years, which and basically gives you a paper loss to offset some of that income on a yearly basis. But with accelerated depreciation, you could accelerate a lot of that depreciation in the first year, probably 20-30% of it. And usually that will create a loss, and you can use those losses to offset future income or other income if you're a real estate professional.
Yeah. And if
I'm not a CPA, but there you go.
Yeah, right. Everybody consult your own CPA. Neither of us are, but we're both, banking a lot of paper losses, I'm sure. I know I am. So
for sure. I mean, it's going down a little bit, but we'll see what happens with that.
The what's going down?
The bonus depreciation.
Yeah. But even the regular depreciation schedule, I mean, on most deals, if you're, having like a fully levered deal, 70% LTV or something, I mean, most of those for me, they're still not kicking off any taxable income, even if we didn't do a cost seg to accelerate. So that's a great insight. How did you make the transition then? You're going from the single families to the multifamilies. What did that look like?
So I owned those duplexes, and then I think it was late 2017, I traveled to Kansas City with my wife because she has family out there, and I was obviously bored looking at deals. What real estate guy doesn't do that? Started like doing some back of the napkin math. I was like, oh, this is interesting. This is like the return on this is really good. I could like 3, 4, 5x like my cash flow, and then started talking to brokers, and probably 2018 started actually looking at properties, and by 2019 actually sold one of those duplexes in exchange into a 14 unit, which was the first deal, and went from making I think 1,500 a month to making 5,000 a month, and that thing's continued to perform really well. And I think I'm making like 12% cash on that property from the money I moved from one place to the other. Yeah, and if you look at the cash on cash and what the original money I put into that first duplex, it's probably astronomical. I haven't actually calculated that, but it's probably insane.
Yeah, I know what you're talking about when you're looking at the initial down payment on the first deal after you've rolled it a couple times.
Yeah.
Yeah, it could be 100% plus the way you're talking per year.
Yeah, for sure. And then that turned into our first deal in Oklahoma in 2020, which we actually exchanged into that, and we actually subsequently sold that one and exchanged into another property, which was 30 years newer, and we hit like a 60% IRR on that. Just good
Nice.
timing in the market, and a good that property was in Norman, Oklahoma, where we have most our like a good chunk of our portfolio now is in Norman, Oklahoma, close to the University of Oklahoma. And so we bought that one, and then we bought a few more. And those first couple, though, we basically did mostly our own money and like a couple friends. And then the next one was more other people's money. And we kind of built from there.
Nice. And in terms of just the geography, I think you said the first one was in Kansas City.
Yep.
And then what do you think the cap rate was on that? If you remember on that first deal you bought in Kansas City, it's
I think it was
2018,
probably
roughly.
like a 7 cap.
Okay,
I
nice.
think.
Yeah.
Yeah, and I
Yeah.
actually bought it flipped to me. Like they did all the plumbing, they did all the electrical, all the HVAC, did all the insides. I think the only thing I had to do later was do some roof work. And that's been huge because all the systems are redone. So I haven't had like that thing runs so lean because I haven't had any major surprises.
Yeah. And then what kind of debt did you do on that one?
That was a CMBS, 3 years IO, 10 years, 10-year loan. At the time, the rates were a little bit higher, but it's still lower than what it is today. I think the rate on that's like 4.8, somewhere around there.
Yeah, 2017. Yeah, rates were started out in the low fours, and then eventually by 2018, I remember them being in the fives, and I was so painful. I did some refis in the fives in 2018, and I wish I could
Yeah,
have
but
that
now it
rate right
doesn't
now.
feel so painful, I guess. Yeah.
Yeah, I know. I wish I could have the rate right now. But yeah, that's. And then, do you still own that, or that was that was the one that you?
Yes, that
Okay, nice.
original 14 unit I actually still own. Yeah.
So then, when that 3-year loan matured, what did you do?
No, it's 3 years interest only, and then 10. It was a 10-year loan. The first 3 years interest only. So I still have the same loan. I mean, eventually maybe refi and take a little bit of cash out and get a new interest only period. But I'm not going to do that right now.
Yeah.
Yeah.
Yeah. And so then, roughly speaking, then what's your strategy on these multifamily ones, just to like draw out the whole idea here? Is a lot of times I hear people, they're talking about, it's a 3-year hold or, 5-year hold, and you're talking more about cash flow and tax efficiency. And this is why one of the main things I wanted to talk about, because what you're talking about now is how a lot of the owners that I know that don't have any investors talk, where they don't know what their IRR is, but they know they bought the deal for like 500,000 in 1994 and it's worth 5 million, and they've already pulled out, millions, and they don't care to sell necessarily. So what's sort of your plan with these, would you say?
Yeah, we're kind of longer term holders, but we will sell if it's a older vintage, or we just feel like it's a strategic time to sell that and hopefully roll that money over into another deal. We are in the process of selling something right now, but I think on that one we might take the tax hit just because I'm just not seeing anything interesting right now. Like I'd rather take a tax hit than buy something that's not a great deal.
Yeah, and then on that one you're selling, I think that one you own with your brother, or also with investors and folks, or how's that one?
We have a good chunk of money in it, and then we own with investors. So we'll see if we actually sell it. We're kind of in negotiations right now.
Yeah, that's I'm sure you've looked into this, but on most of the deals that I've sold that we haven't done 1031s on, I had enough banked passive losses from the depreciation that I didn't personally need to pay any. Yeah. So I try to not, I still want to do a 1031 for my partners and investors that don't have that situation. But for me personally, I don't think I've paid tax on the sale yet either. I've just had so many losses banked. So you might be in the same boat.
Yeah, the only tax I paid was the sale of my residence in California, the state of California, because a lot of the states don't recognize the accelerated depreciation.
Oh, interesting. Yeah, no surprise. And California does not.
No.
Interesting.
Yeah.
That's I'm not surprised for some reason. But
Yeah,
that's
I was like, I mean, if you're paying the other way to look at it, if you are paying some tax, you're probably doing something right, you know?
yeah, no, I know. I would like to be in a spot where I have, blown through all those losses and I've, made so much that I am paying tax, but it's almost hard to do if you're just going to acquire long-term rentals, which is our,
Yeah.
basically our businesses. So,
Yeah. Yep.
where I've, thought to myself, I need to start like a coaching program or something that will be printing money to ever, eclipse that. Anyways, yeah, but I don't, I'm not really, going that direction, but I think,
Yeah, it's not my cup of tea either. I'd
yeah.
rather just help people out for free here and there and just call it a day.
Yeah, yeah, that's what I've been doing too. I saw some people where it's like they're just printing money where it was wild when I saw the math on it, like 8 figures a year kind of thing.
Especially 21, 22, all these like real estate gurus or whatever you want to call them. Yeah, they were printing money for sure.
Yeah, no, I know. So I didn't realize what was going on, to be honest, Jonathan, until about a month ago when I heard the numbers. And it's like, it's how much per person, and there's 400 people or 1,000 in this. Like, okay,
Yeah, 30 to 50 grand, a lot of them per person.
yeah, So I was not aware of that because but I think and how did you figure out
Not that it's all bad. You could easily make your money's worth if they save you from making a big mistake. But
yeah.
yeah.
Yeah, I think as long as you can put it into action and you need the info, money well spent, no doubt.
Yeah.
How did you figure out to look at the return on your equity based on the new value, what it had appreciated to, versus just the cash you put in the deal? That was interesting. You mentioned that because most people don't talk about that.
The return on my new equity or the original.
Yeah. So let's say you
cash?
put $100,000 down on a deal, but now it's appreciated. You paid your loan down. You were talking about how you're looking at the return on the new amount, not the 100,000 on whatever the actual equity is now.
What my actual equity is on the property. Yeah, I think when I was looking at selling, in particular on those duplexes, I was looking at, okay, yeah, I'm making 10% on my original cash, but now this property is worth 500,000 more. And now I'm making like 2-3% on that equity, and I could move it to this other place and 4x it. It just like made a lot of sense financially to look at it that way and keep on moving it. Not to say that's always the play to do, but I think when you start hitting that, like you're only making 3-4% on your equity, you got to start looking at kind of making some moves.
Yeah, because it's interesting. Or I've looked at stuff the same way, but I'm not.
Or maybe
I
a
don't
refinance at that point. Yeah.
Yeah, no, I know a guy who has quite a few paid off properties now, and he, just talks about how much he's making in total numbers. But then I'm thinking, yeah, but that's a $5 million building with no debt on it. Like that's actually like a 3%. It's like it's not more than 3, but that's like a low return. It was like 5 or something when he said it. I'm like, that's not. I know it's a lot of money, $250,000, but not on 5 million in. So
exactly. But maybe that helps him sleep at night, and
it does. And he's
his own,
And he's on the like backside of his career where he's retired, so it makes sense for him. But I was trying to explain that, and he was like, "Yeah, I understand. I get what you're saying. I just don't want to do it." Was basically the response. But I don't really hear that talked about too much to like look at the return on the new money. Cause yeah, you're right. You own that, let's say that first OKC deal, for 10 years, you either, could pull out a bunch of money on a refi or, sell it and roll it into a bigger deal. And you're going to be looking at what's my return on this. Essentially, like if I were to sell it, like the money I'd get, like, is it enough to stay in the deal or should I roll it? Like, it sounds like that's how you're going to be deciding that.
Yeah. Maybe look at that value very conservatively because you don't know what actually you're going to get paid until you actually put it on the market. But if you have a pretty good idea, maybe take a discount of that and then base it off that, then it could make sense to kind of evaluate it that way.
Yeah, I've even factored it in with potential sale costs and not taxes, but at least the sale costs. Just go like, truly this is what you'd be walking out the door with. Like, would that be a good return or not? Just staying in it. But then what did the next deals look like? So we got the first one in I think I said OKC, but it's actually in Kansas City. And then
the next one is in OKC in Norman.
All right, nice.
Mm-hmm. Yeah,
nice. And what did that deal look like? That was
it was a 72 unit deal. that we bought in, I think it was September 2020. It was, it more needed to be operated better. It was like East Coast, kind of had like 30,000 units, and that was their like one like random one, and they just weren't paying much attention to it. We also added a unit there, and just kind of did some change branding and did a few things, and then we sold it in it was October of 2022 for, so we bought it for I think 3.2 and we sold it for about 5.2
Nice.
2 years later. So yeah, it was great. And then we
Crushed
moved
it.
that money into a property we bought about a year ago, which was 30 years newer in Norman as well. So that's actually an
Kinda like
interesting
that.
story. Yeah, that's an interesting. And actually, that other property that we exchanged into was the same seller that we bought that original one from. So we made money off that deal and then bought another deal from them with the money we made off them, I guess, sort of. I don't know.
Yeah.
Yeah.
No, that's interesting.
Yeah.
From the same East Coast group, they like, we have
Yeah.
another one for sale. Okay. I like that.
Yeah.
No, that's
Yeah. But that helped us because they were familiar with us and we closed and they know we were serious and all that kind of stuff. But the funny thing is we put that one under contract, and we knew we needed to get funds from somewhere. Like we knew we weren't going to be able to raise all the money just for that deal, just because the reach we have or whatever. And so we were like, they didn't give us, part of the contract wasn't that it was like we had to sell that, but they knew that we were selling that to buy this. So they kind of gave us a really long escrow to kind of pull it off. And we put that on the market, got it sold, I think, in like 60 days, closed 3 weeks before we had to close the other one, move the money over there, and it all kind of worked out.
so,
And
so the first deal you bought from them, was that the one that you sold once you were under contract on the second one from them? Or
Yes,
you sold
yes.
two? Okay. I didn't know if you sold
Yeah.
two deals there for a second.
No,
Okay.
just that one deal. We moved the money into this new deal, raised a little bit of money, and then closed on that one. And then
Wow. Yeah.
between, what's that?
I was gonna
Yeah.
say you sold that deal fast. That's great.
Yeah, yeah,
It's a quick
put
process.
on the market. It was a clean property. We got lucky and we had a 1031 buyer come in and just like was ready to close. And then between those two deals, we've bought in three more. One's in Norman, 118 units, and another one in OKC, 69 units, and then a 74 unit deal in Kansas City as well. So we have about 420 units, 35 million in value, sort of say around there. And yeah, the last year or so, we haven't been that active just because where the market is. And also we had made a transition from another management company to a new one. And it got a little bit rough there, and operations dipped a bit. So we were kind of focused on that as well,
Yeah, that makes a lot of sense.
which kind of worked out because there wasn't
yeah.
really much deals to be had anyway.
Yeah,
you
it'd
know?
be better to have not bought anything. So
Yeah. Yeah.
I was
So it's
just
kind of good that
explaining-
we were forced to sort of not buy anything. Yeah.
Yeah, I was just explaining it to somebody where the last year has been tough, not having bought anything. It just seems like money's just going out the door. But then it's like, but we would, those weren't the deals to buy. But I think about now is the time. So I was telling
Yeah.
them, like, we're
2024
deals-
is going to be really interesting,
Yeah.
And I'm
I mean,
already
rates are-
seeing distressed deals and things kind of popping up for sure.
Yeah, because at this point, what are you looking for new deals then? So it's still cash flow focused, or now maybe a little bit more of a value add play, just given the distress comment, or what are you thinking?
I think, yeah, a little bit more value add. We're even looking like where my 14 unit is. We've kind of started poking around doing just a smaller deal, but doing it all cash and like doing everything, doing all the systems, the plumbing, the electrical, the roof, but obviously buy it at a price to make sense to do all that. Just because with our current assets, one of the things that's made us struggle a little bit on some of the properties on operations is CapEx stuff, surprises that have come up, because some of it's older 70s product, for example, and like just plumbing stuff, HVAC, whatever. And so focusing on either buying maybe something newer moving forward, or buying something where we could actually like fix everything day one and not have to worry about that later, or have less surprises. And like the return that we're expecting is the return we're going to get, because we're not going to have all these things come up.
Yeah, and you'd be the person asked for this because of the renovation background too. And so then when you go to these apartment buildings, and what are you looking at physically? What do you think is important to be able to assess as a buyer?
I mean, we check the roofs, we check all the HVAC systems, we hire a professional inspection company to do a sample size of the units, and we try to walk every unit ourselves. And we've been more strict on doing that. In the past, we haven't walked every single unit, but it's like important. Like we want to document, like, you know, in what condition all the units are in, because what happens is when these units turn, we want to have an idea of what the turn cost is going to be. And there's no way to like completely 100% estimate that. But if we have a general idea, like, man, 50% of these units are wrecked, we're going to have to really up our turn costs over the next few years. And then scoping all the lines, and, you know, just generally walking it, checking the windows. I mean, we try to be really thorough, but you could be so thorough, but things are still going to come up no matter how thorough you are. And you have to keep enough. That, I think that's something moving forward, is if we do end up buying anything newer, we're definitely upping our CapEx dollars than we had allocated before, even though we had allocated a lot of money there. It was a little bit more than we thought.
What would you think you would assume for some of the additional CapEx? How would you quantify that numbers wise? Because then a lot of people, the rule of thumb is $250 per unit per year. You're thinking that's not how reality is. They run higher than that, and you would
do
something else.
I think that's fine, but also having probably at least a couple grand per door in reserve from the get go, on top
and
of
that's
adding
just
to
okay.
it.
Yeah, and that's just that's sitting there for whatever CapEx comes up, whether that's immediately or in year 4. It's just going to sit there.
Yep. Yeah, while you're adding to it.
Yeah, that makes a lot of sense. I think a lot of the deals that we've owned and operated, I mean, they've all, for the most part, the CapEx kind of non-recurring type expenses, that's more than 250 units a door, or sorry, $250 a unit. I mean, I saw something where it was like like what they were operating at. It was over $1,000 a unit for CapEx type stuff. And that would include like replacing appliances and, carpet and common area, stuff. And so I think that's why that's as
crazy
high
to me, honestly. Yeah.
I know, that's what I tell people when they're like, yeah, the broker's got 200 a door in this for below the line. I'm like, I mean, 500 minimum. And usually I'm doing more than that. Like that's not, and once you own it, you see how how they run. It's funny. We both started laughing at the same time.
Yeah.
But yeah, that's and then what are you looking at when you first tour it? That's actually I wanted to ask that in terms of the physical condition. You're gonna go, I want to see try to see what the plumbing material is, the drains.
You're saying when we're under contract or before we're under contract?
No, initial tour. Are you looking under the sink going, I want to see what's coming out of the wall, or how?
I wouldn't say we're that thorough, but we try to walk as many units as we possibly can, and potentially if it looks like the property does need work, bring a contractor with us and kind of poke around. But I think if maybe we're like in the best and final, then maybe we would dig a little bit more in that way. And then obviously if we're under contract, and if we're going to do hard money, which we rarely do, then we'll do more up front as well. But if we're not hard money and we have like a 30-day due diligence period, we'll just get right to it.
Okay. Yeah, makes sense. Yeah, I try, if it's built like before 1990, try to look at the plumbing, what the plumbing is for water supply, drains, electrical, windows, roof. And by just doing what I was saying, look under the sink, look what's coming out of the wall to the toilet. Because I mean, let's say it's a deal that they did a nice renovation, but then they never did the plumbing, and you still have old galvanized pipes or cast iron drains that should have been replaced 20 years ago. I don't want to waste like 2 minutes on that deal. It's just going to be a mess for somebody. And if it wasn't renovated, then fine, let's underwrite it as a gut renovation and see if it makes sense. But if they already did a cosmetic renovation, they're already getting solid rents, and it's not going to make sense to go back and fix these things. And so those deals, I just pass on. I don't want to.
Yeah, or you allocate a lot of dollars to it, but then the price is not going to make sense.
I never get them. I've realized someone who doesn't, honestly, I feel like know how those things work yet. And they're like, yeah, it's renovation, looks nice, quartz counters, it's great. But they don't realize their electrical panels are the ones that catch on fire, or the, or their plumbing should have been switched out 20 years ago in 1990, and it's still being, limped along. Like, so I just, that's
yeah, we take a look at like if it has copper wiring, copper plumbing, what is it, original cast iron, the panels too, because for insurance, if you have like the Zinsco or the old school panels, you're gonna have to replace that. And we did that on one of the properties that we own. I actually flew my electrician, not flew, he actually drove from LA to Oklahoma with his crew and shipped all the equipment to the property and had him do it, because it's actually faster and cheaper for me to do it that way.
Yeah, that's interesting to hear that. I'm not surprised. I did that with a painter that I had in Chicago. I sent him to another state where I was like, he can paint this hallway, and the whole building so much cheaper that it's like, he wasn't asking to stay at a fancy hotel either. So we're all worked out.
They stayed in the model unit. We didn't even put them in the
even
hotel.
Yeah, even better. Just didn't have a model, so it was he would have to sleep in the hallway, and I don't think that's a good look. So
yeah,
that's
cool.
But yeah, that's a good. But yeah, no, I figured you were looking at that stuff on the front end, because I've learned now to just kind of, if they did one of those, we'll call it cosmetic rehabs, where there's just always someone who's overlooking that, it seems like, and are ones that I haven't touch. But then oftentimes we're surprised where it's like then that stuff has been replaced, but maybe back in the 90s or early 2000s, and it still feels old inside now because of when they renovated. So now we can be the ones doing the cosmetic rehab, because all the
that's the best deal right there.
Yeah, all the bigger ticket items are already done. That's basically the only rehabs we've done for the most part, is where they're not a gut rehab. It's more lighter lift, but in an area where you can get a big pop in rents if you get the finishes right.
Yeah, that's the ideal one right there. But yeah, a lot of people, it's like the hot potato. They keep passing the hot potato until someone has to deal with it, And someone has to actually deal with the plumbing, deal with the whatever. Yeah, that's what's been happening a lot in the last 10 years.
Yeah, I feel like you can see which are the hot potato deals if you open the drawers. Almost, that's how it's like the cabinet fronts are new, and the drawers are like, oh my god, these things they barely work, and they already have water damage, and But that's the lipstick, on a.
I think that's where our experience doing 400 flips really comes into play, because like we just have an eye for that. We could see that, like, oh yeah, this is going to need a lot. Like this, we're going to have to do this, or like, even if we don't replace this, it's going to be a headache, or there's going to be there's going to be so many things that you lose control over,
I heard you at some point, it was on Twitter or a podcast or something, you were about to hire somebody, or you did, they were just going to reach out to owners. Did that like direct? Did you ever do that? Did that work out? Do you not know what I'm talking about at all?
Maybe I did. I don't remember. We did. We have kind of worked with some people that have called on our behalf, but it hasn't been that successful. Honestly, it's been more just through brokers, or like actually a couple of deals that we bought were through like the DMs and Twitter too.
Yeah, and I don't think we've talked about Twitter. So how has you're on Twitter? What are you doing on Twitter? How has that helped your real estate career?
Yeah, just kind of talking about what we're doing, and just like interacting with people and learning from other people. And then, we got a couple deals that way, just kind of putting out there what we're looking for. And then also I've met some LPs that have eventually invested in our deals. And it's just kind of been a fun place to just see what people are doing. And it's like, I feel like it's kind of like the break room in an old school company where everyone's kind of hanging out, shooting the shit a little bit about real estate.
Yeah, it is, and that's how
bullshit,
we met,
and all the drama that might come with that too.
Yeah, no, I know it's been getting funny the last couple of weeks.
I haven't been paying attention. Like as soon as it gets weird for a bit, I'll like kind of back off, and then I'll jump back in later.
Yeah, some of the anonymous accounts that are on there. So it's be like a something guy account, you know.
Yeah, the guy thing is ridiculous.
But some of them, someone figured out some of them are connected. That's the latest drama because they looking at their posts. It's like this person posted this in October. Now a different guy recycled it in November. And then, you know, like, and it's like they're, so then that was the drama, I guess.
I saw someone posted that they were like creating guys. There was like a website.
Yeah.
I went to the website and they were like
The Guy Factory.
You could pay. Yeah, you saw that too.
There's
and
a Twitter account and he talks about all the guy accounts he's running. Yeah.
Yeah. And people are paying him to run their guy accounts. I don't know.
Yeah. You can go to, I think it's at Guy Factory and you could send him a DM and say, I want you to run the apartment guy and let's secure it or buy it off of whoever has it. And you write it. Maybe they do like a Zoom call a week with like, hey, here's some ideas. And then the guy behind the guys runs it. Yeah. It's like an asset they're developing.
Yeah, I mean, I think but that's the issue with it. It's like, I think the accounts that do the best are the real people that use the real names and people that are doing their own posts, because then it's just not as authentic and people could feel that or see that.
Well, and if your end goal is to have deals or raise money, it seems unless you have just a massive account, you know, like some of these guys that have eclipsed 200,000 plus followers, it seems like that's a very hard conversion. Like personally, I don't feel comfortable investing with a anonymous Twitter account. Like with my own money, let's say, I think that's crazy.
I mean, I'm guessing eventually if you talk to them DMs, you might find out who they are. You eventually have to find out who they are.
You will, yes. Yeah, you do, but just the whole conversion is too hard.
It seems more sketch. Like it's already could be sketch giving someone you meet on Twitter money, let alone someone that initially didn't have their name out there.
Yeah. And so I think, but it's interesting for learning and for meeting people for sure. I mean, that's how we met. And then that's awesome. You've had investors come through from there. We've had people sign up on our investor list from Twitter, but I don't recall if anyone's actually invested that then hit the list that was a Twitter person.
Yeah, I think we've had like 30 people invest from Twitter at this point. But I talked to 300 people to get there, you know?
Yeah, I don't doubt it. Yeah, I've got more from LinkedIn so far that have converted. That's been better for me. But obviously number one is the real world and referrals.
That's our big LPs are just people we've known along the way. Like actually where I used to live in LA, a neighbor that lived one street over I didn't know him because he was a neighbor. I knew him through some random stuff, but then realized we live right next to each other, and he's probably one of our largest LPs now.
I mean, that's the best way to do it. And that's makes a lot of sense. And sometimes too, like if I think I mean, there's so much more of a trust, like you know, just kind of it's like a real world, you know, relationship versus, because some of these, I mean, a few of the people that have invested from LinkedIn, I've just still never met them, which that's fine with me, I guess. But you know, for me investing, I would have, so I offered to meet, like, I'm happy to, you know, but then they're like, no, it's fine. Trust what you're doing. Listen to 20 podcasts. I know what you think like it's fine.
Yeah. There you go.
But yeah, that's that's great. How are you? So then sourcing deals, I mean, maybe to kind of go back to that, it's through brokers then is the primary.
Some random people off Twitter that have connected me to people that ran into deals. One deal that we bought in Kansas City was through a broker, but the management that was in place was the management that I use on my 14 unit. So he kind of had like an in there and kind of like gave us the roadmap of what we had to do to kind of get the most bang for our buck there, and kind of just had the confidence level to really like we still weren't the highest offer, but the seller felt comfortable with us. I'd been talking to the broker for like 3 years and hadn't done a deal, and finally we did a deal together, kind of thing.
Nice.
And that one is an assumption deal at 3.99% that we did earlier this year. And so that just kind of like the stars aligned because of, you know, it's like this business is a people business, and if you know like different players doing different things, and you can get different info here and there, you could kind of you kind of use that to your advantage, I guess.
Yeah, makes a lot of sense. Is there anything at this point where that comes to mind if I'd ask like something that you know now, having done a bunch of these multifamily deals now, that you didn't know when you had those just the duplexes, let's say, that's like would be important to share? Let's say, I mean, obviously you've learned a ton, so it's obvious you've learned stuff.
I think
But
we kind of touched on it, and I think I knew the systems would be an issue, but I think I didn't realize to what how much of an issue it could be, and how to exactly budget for that. And I think we have just a better, clear idea of how to budget for that, and just more now we have more an incentive to maybe look into doing heavier value add, so we could touch all those things and buy things at the right price. And right now, I think a lot of times we weren't looking at those heavier value adds because they were pricing in the value add too much into the deal, that it was like, I'm not going to pay you for the work that I have to do, you know?
exactly. Yeah.
And now hopefully that's changing. And I guess we'll see as we start to look at more deals probably next year. We hadn't been looking, like I said, we hadn't been looking at too many deals the last year just because we were focused on operations and the market was weird. But I think in 2024, we'll start like digging in more. And I think another benefit with us is like, we'll go pretty small and we can go like up to 10 plus million, but like we're more, we could be a little more opportunistic with deals than like having to hit like a certain like IRR niche thing. Like we could be more creative and flexible because a lot of the money has come from us, or just kind of how we've trained our LP base, I guess.
Yeah, and you don't have a lot of overhead, I would assume, if the business is
it's
you
me
and your
my
brother.
That's it.
Right. There's not a fancy office building and a big team there.
No,
that forces you to do a deal.
I hire people on Upwork here and there if I need a little help with something. But yeah, third party management. But sometimes I feel like we're part of their company because we're so involved. But yeah, like I feel like the managers on the site are like my employees in a way. It's weird.
Yeah, I mean, well, they really are. I mean, they work.
They are my employees, but
yeah.
I don't have to deal with the HR part, so that's
yeah.
better.
No, I know what you're saying, because I do the same thing. Even like for our leasing people, I was like, I just am going to need their cell phones because I'm texting the regional about something. This is like too inefficient. Like I'll just let me talk to them. Like this is not. Like your ad's not showing up right, and I'm looking at it. Like I just need to talk to the person.
Yeah. And we do weekly calls, and I have full access to the property management software. So like there's a lot of communication. We try also to let them do their job. Like I don't want to like micromanage, but we are pretty involved. But it shows. Like the squeaky wheel usually gets the most attention. So there you go.
Yeah. Yeah. So I mean, in terms of just the advice then at this point, it's, budgeting $1,000 or $2,000 per unit on the front end for,
I would say 2
CapEx.
I think it depends on the vintage. Like if you're buying something 2000 and newer, maybe you can get away with 1,000. But older, maybe 2,000, and then allocating monthly a certain amount. A lot of lenders are going to make you allocate a certain amount every month, but you might still need more,
Yeah, you need more. That's what I've learned. And then on the operations, where even if you're going to hire a third party manager, it's not going to be passive for you, the operator. You need to still drive the business plan and help set the rents and all that. That's
renewals. Taking care of any larger CapEx projects. Like if something gets expensive, like, hey, let's get more bids. We're super hands-on. Like if something, like we have budgets per line item, if something's off, why is this off? Why do we spend $200 on a oven handle? I won't dig in that much usually. Like that's a little extreme, but like if something seems off, then I'll dig a little bit more, and I'm like, what's up with this? Like we can dig into every charge and look at every receipt and kind of like really dig into it if we feel like we need to. Not that I want to do that every time, because I don't have that much time in my day to just dig into every little thing. But we have the option to do it if we need to, if something's off.
Yeah, and I think it is important to be digging into the level you're talking about, because maybe that's one oven handle, but if we're going to be spending half the cost of an oven to do repairs, maybe it makes more sense to just be like, hey, it's got a problem. Let's just replace it. At that point, it wasn't a new oven, but I've been in the same boat. Then the answer you hear is, well, we didn't know what was broken. So the guy went there, that already cost $95. And at that point, the handle was $95 more. So that's why I'm in for $200 on a handle, where, because I've been down that same rabbit hole. So then I try to say, like, on the front end, if it seems like it's a big piece of broken, just get a new one on some of those things.
Yeah, or like, do we have to vend that out? Could the tech done it in-house? Like, having those conversations, you know? And I think they know that you're like kind of watching over a lot of things. It kind of makes them better too.
Yeah, for sure. Well, great, Jonathan. Yeah, this was really fun. Good conversation. Where, so how do people get in touch with you? They want to reach out. Where should they go?
My website, JB2Investments.com, or you could also find me on Twitter at JB2 Investments. Those are the two best ways, I would say.
Perfect. All right. Well, thanks, Jonathan. Great job. Appreciate it.
Thank you.
If you learned something from today's show, leave a review and hit that subscribe button wherever you enjoy your podcast. Dive deeper into real estate investing on Brenneman Capital's website, brenneman.com, where we have numerous free resources and information that can help both active and passive real estate investors. Accredited investors can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Brenneman and guests as of the date of recording and do not purport to reflect the views or opinions of Brenneman Capital LLC and its subsidiaries. Views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities. The speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.